Joining us now to discuss is former Richmond Fed President Jeffrey Lacker. It's good to see you, Jeff. So do you expect
Good to see you, Sarah.
Chair Powell to lean one way or the other? I mean, he could go hawkish because inflation is still above target, but then we've also seen this big backup in long-term rates.
Yeah, there's nothing in it for him to take interest rate hikes off the table and signal a definitive pause for a long time. As Steve said, I agree with him. He's going to keep them on the table. They're still far from getting done, bringing inflation under control. We had great numbers in June and July, but that was kind of that looks transitory in hindsight. The last 2 months have been less favorable. Yesterday, we received the highest quality report we get on wages and compensation, and it showed that basically wage deceleration stalled out 12 months ago. So wage rate gains don't seem to be coming down in a material way. And against that backdrop, the UAW settlement being so rich, they're a tiny fraction of the workforce, maybe like under 0.1%. But if that's a harbinger of stronger wage settlements in other unionized areas or other areas, that's a concern for wages. So they're far from getting it under control. Recession risks have definitely receded in the last 6 to 10, 12 months. They're not totally gone, but they've receded. And compared to past recoveries, they are 2 to 4% behind where the real rate typically gets in recoveries in which the Fed has been able to contain inflation from the 80s through the 2000s. So in that setting, pausing is a bit perplexing and would seem to be a signal of some elevation of the employment mandate over their price stability mandate, if you ask me.
So if you were at the table, it sounds like you'd be leaning toward more hikes, and that's the case that you would be making. On the flip side, though, Jeff, you can make the case that the wage acceleration has stalled out and is coming down. I know the ECI number was a little bit firmer yesterday, but it's still in a downtrend. You see that in the ADP numbers as well. And you see that in most of the inflation numbers, that even if they're sticky, they've come down very far. And at the same time, we have this big rise in rates at the long end, which is going to hurt the economy and the consumer. And maybe we haven't felt it yet, but it's going to happen.
So inflation numbers and wage growth numbers have come down, but that comes when you look at the 12-month numbers. And what you have is the strong gains from 2022 rolling off. If you look over the last 6 months, it's much less clear that the downward trend is very strong. And so, yeah, it could continue. It could pick up and we could get further downtrend, but they're not there yet. It looks like 3.5% or 4% is where inflation is right around now. And so they've got a ways to go is the point.
So you think the market is wrong to assume that the Fed is done raising rates? Because right now it's not priced in for December.
So the market's making a judgment on what the Fed's likely to do. What I just described is an argument for what they ought to do. Those might be two different things. Yeah. And so I think, if they stay on the path they are, like maybe one more increase, maybe in December, maybe in January, if they go fulfilling those expectations, they're going to get to a point in the second quarter where, it could be the case that the inflation data doesn't show much more deceleration, and they're going to be on the hook for whether they're going to raise rates again and get people prepared for further tightening or not. And it seems to me like laying the groundwork now for a higher probability of further hikes would be prudent.